Well, in the second part, the part of the chapter number 5, preliminary audit planning, understanding the auditee's business. Understand the auditee's business environment and risks. So that's important to understand the business and the risks faced by that particular type of a business. So understand the client's business and operating environment is very important in an audit. It helps to assess the risk that financial statements might contain, material misstatements, used to establish an overall audit strategy, design the audit plan and the audit programs. Understanding the client's business significant risk. What is the underlying economic reality of the entity's financial condition and performance? This is what the financial statement should capture and communicate to users. Business environment risk related to industry, that's overall business environment or the economic situation of the as an industry. Then what are the requirements from regulatory or economic related and other external factors. Business operational risk related to strategy and related business processes, investment, financing, and performance measures. So one strategy is outside factors, regulatory bodies, requirements, the macroeconomic indicators, and the industry overall performance in the economy, and the internal factors that the processes, the investment decisions, the finances required for the doing the business, and all these things that this is related. What could have gone wrong in preparing the financial statements? That's an assessment that what can be possible that they can report incorrectly, or there's a misstatement or a misreporting. So that's an assessment before real starting. So this leads to misstating the financial statement. Entity risk related to corporate governance, management, quality, related parties, internal control, accounting policies, and information systems. So these are the areas that can be possible in which there is a misstatement of the information. In order to design an effective audit, auditors must understand the business and the economic environment of the business, including factors such as national economic condition and policies, overall macroeconomic indicators, geographic location of the business, development in taxation and regulations, and specific industry characteristics. Analytical procedures requirement. Although particular analytical procedures are not required by the audit standards, the timing of these procedures is specified. At the beginning of the audit, when planning is taking place, and at the end of the audit, when the partners in charge review the overall quality of the work and perform an opinion. General analytical procedures. 5 types of general analytical procedures the auditor firm should adopt. One is compare current year accounting balances with one or more comparable periods. Like if you are doing an annual, so you have to compare with the last year or the year before. Compare current year account balances and the financial relationship with the similar information for the auditee's industry. Then you compare this firm with another firm of the same in the same industry, so that you can understand whether the statements are correct. Compare current year account balances with the company's anticipated results or the budgeted figures. Evaluate the relationship of a current year balances to the other current year balances for conformity to predictable patterns. Study the relationship of current year balances to the relevant non-financial informations. So analytical procedures are most effective when integrated with other sources of information. Many other early information gathering activities can also be considered analytical procedures. Review of accounting misstatements discovered in the prior years. So read the audit reports of the prior year so that you can identify is there any misreporting or qualifications in their reports. Conversations with the auditee's personnel. Conversation with the auditee's personnel. Review of a means you have to discuss the firm's performance and all these things and their past figures with the auditees personnels or the management. Review of a corporate charter and bylaws or a partnership agreement. So whatever if there's a corporation, that you have to go over their charter or bylaws and partnership agreements or all these things. Review of a contracts, agreements, and legal proceedings. Read and study of the minutes of the meetings, like a board of directors meeting or all these things. Preliminary analytical procedure also provides an organized approach. They provide considerable familiarity with the client's business and provide a standard starting point. Describe financial activities by identifying relationship and change in data, and allow the auditors to ask relevant questions. In addition, the auditor should analyze the cash flow statement for irregularities such as cash deficit from operations. The cash flow statements will reveal aspects of the client's business not evident in the financial statement. So cash flow is a way that you can assess whether the firm is in a good standing if their cash flow is not any type of problem. The cash flow statement will reveal aspects of the client business not evident in the financial statement. For example, cash deficit from operation might signal financial difficulties. Then comes the point which we discussed in the beginning as well. Materiality is one of the first important judgment the auditors must make, since it affects every other planning, examination, and reporting decisions. Materiality is the largest amount of uncorrected misstatement that might exist in the financial statements that still fairly represents the company's financial position and results of the operation. Like I give you an example, it can be a 1,000, it can be a 5,000, it can be a 10,000. If there is a misstatement of a $10,000, if it is the financial situation of a company is in millions of dollars, and out of which if there's a 10,000 misreported or not correctly reported, then it doesn't matter so much. But if the statement is of just a $500,000 and the profit is of about 70 or 80,000, and in that case, if it is misreported by 10,000, it is a material impact. So it's not the value is fixed for every organization. It depends on the size of the firm. So materiality, that we have to decide it. Materiality level for audit planning, part 2. Financial statement materiality information is material and should be disclosed if it is likely to influence the economic decisions of the financial statement users. Focus on users of financial statements. Accounting numbers are not perfectly accurate because the nature of the accounting. Estimates are used and honest mistakes happen. Some inaccuracy is unavoidable. Unimportant inaccuracies do not affect users. Cost of finding and correcting small error is too great. Time to find all errors would clearly delay statements. So to leave a room for error and reduce the probability that the total misstatement exceeds materiality, auditors will determine an amount of performance materiality. The difference between financial statement materially and performance materially is a cushion for misstatement that were undiscovered by the auditor. Materiality judgment criteria. Materiality is both a quantitative and a qualitative judgment. Auditors cannot rely solely on a quantitative benchmark. Small misstatements may be material in some cases. For example, make a change in earning or other trends, hide a failure to meet analysts' consensus expectation for the auditee, change a loss into net income or vice versa, concerns a segment of the business that is considered significant, affect the audit's compliance with regulatory requirements, involves concealment of an unlawful transaction or a fraud, and has the effect of increasing management compensation. For example, satisfies requirement for the award of bonuses or other forms of incentive compensation. Materiality judgment criteria quantitative. Auditors are generally left without definite quantitative guidelines to determine materiality. Quantitative guidelines, 5% of the income from continuing operation. That can be a one criteria. 5% of net income before bonus, 0.5% to 2% of a revenue or expense for non-profit entities, 0.5 to 1% of a net assets for the mutual fund industries, or 1% of a revenue for the real estate industry. In some circumstances, the auditors may also select alternative financial statement item for establishing materiality. When income measures are used as a basis, they should be normalized or averaged. In addition to quantitative guidelines, the auditor should consider other factors as well. User-related factors, nature of the item or the issue, other circumstances, effect on share price. Auditors must consider the sum of known or potential misstatements. Consider 5 errors of 15,000 each to be immaterial is inappropriate when materiality is determined to be 50,000. Right? So there's the cumulative effect of any error. If it is bigger than the materiality, like if we are considering that 50,000 is a materiality level, so 15,005 impacts, it means it's 75. So it means it should be, it should not be ignored. It should not be ignored in this way that it is the total value is greater than, or a cumulative value is greater than the overall material level. Audit planning is an ongoing iterative process. The preliminary planning activities are the basis for the overall audit strategy. The audit strategy guides development of the detailed audit plan, which details the nature, extent, and timing of the audit process. The audit shall establish an overall audit strategy that sets the scope, timing, and direction of the audit that guides the development of the audit plan. And lastly, the overall audit strategy, how we can summarize this. In establishing the overall audit strategy, the auditor shall identify the characteristics of the engagement that define its scope. One thing, ascertain the reporting objectives of the engagement to plan the timing of the audit and the nature of the communication required. Consider the factor that in the auditor's professional judgment are significant in directing the engagement team's effort, considering the result of a preliminary engagement activities and where applicable, whether knowledge gained or other engagement performed by the engagement partner for the entity is relevant, and ascertain the nature, timing, and the extent of resources necessary to perform the engagement. So this is all what we want to discuss regarding the preliminary strategy or the preliminary planning for the audit. So this is all what I want to share with you or discuss with you from this planning point of view. Hope you enjoyed it. Thank you very much. Bye-bye.